All right, let's talk about Markel Corp. It's this really interesting financial holding company, and you hear it get compared a lot to one of the biggest names in investing for some very good reasons.
I mean, who isn't, right? If you're an investor, you're always on the lookout for that next great compounder. A company that can just grow and grow for decades. It's kind of the holy grail. And that search, well, it leads a lot of people to Markel.
Yeah, that's the name you hear all the time, Mini Berkshire. And look, that's a huge label to live up to, but it points to a really powerful idea at the heart of the company. It's basically built on this three-part system, a three-engine machine, if you will, all designed to generate capital and then grow it for the long haul. So, let's get into it. Let's break down how this whole thing actually works.
Okay, so the whole machine really gets started with its first and most foundational engine, insurance. You can think of this as the part of the business that generates all the fuel, all the cash for everything else they do. But here's the key. Markel is not your average, everyday insurance company. And this is really the secret sauce. They don't try to compete with the big guys on, say, your standard car insurance. No way. They operate in what's called specialty insurance. Think about all the weird, niche, and complex risks out there. Stuff that's really hard to put a price on. We're talking about things like professional liability for an architect, insuring a high-value horse, or a multi-million-dollar classic car collection. You need serious expertise for that, and that expertise creates a protective moat around their business.
Now, this is super important if you're looking at the company today. They just made a huge strategic pivot. See, they used to have this big global reinsurance business, but pretty recently, they announced they're getting out of it. Their words, it was serially underperforming. And this wasn't just some small change. This was a massive decision to focus and double down on their profitable specialty business. The outcome? It freed up something like $1.2 billion in capital to put to work somewhere else.
Okay, so we've got the insurance engine generating cash. Now let's talk about engine number 2, the investment engine. This is where all that cash gets put to work to grow. It's the compounding part of the story, and it's all made possible by one of the most powerful concepts in finance.
And that concept is called insurance float. Think about it. When you pay your insurance premium, the company gets to hold on to your cash until a claim needs to be paid. That could be months or even years down the road. So they're sitting on this enormous pool of money, the float, which is basically a giant interest-free loan from all their policyholders. And they get to invest that money for their own benefit. Now here's the best part. If they're good at underwriting and collect more in premiums than they pay out in claims, they are literally getting paid to hold and invest other people's money. It's an incredible advantage.
And we are not talking about small potatoes here. The scale is just massive. Thanks to that float, their investment portfolio was worth, get this, over $34 billion. That's a huge pile of capital being put to work in stocks and bonds day in and day out. And that is the second powerful engine of this company. So we've got insurance bringing in the cash and investments making that cash grow. But what if the stock market looks too expensive? Or what if competition in the insurance market gets too tough? Where do they put their money then? Well, that's where the third engine comes in, Markel Ventures. It's like their strategic third option. Markel Ventures is basically a collection of regular, non-insurance businesses that they own outright. We're talking about companies that make everything from bakery equipment to luxury handbags. It's a really diverse group, and they're super disciplined about who they let into this family of businesses. They have this strict 4-part test. They're not looking to buy broken companies and fix them up. Nope, they want great businesses that are already humming along with fantastic management that they can buy at a reasonable price and, ideally, just hold forever. Okay, so that's the 3-engine model. Insurance, investments, and ventures. It sounds great in theory, right? It's a really elegant system. But for us as investors, the only thing that matters is, does it actually work in the real world? Let's dive into the numbers and find out.
All right, looking at this table of operating income, the first thing that probably jumps out at you is the volatility. Just look at the investment line. A massive loss in 2022 when the stock market tanked, but then huge gains in the following years. The insurance business can be pretty lumpy too. But now, look at Markel Ventures. See that? It's just a steady, solid grower. It acts like a bedrock of profit, providing stability when the other 2 engines are all over the place.
And if we look at this as a bar chart, the story becomes even clearer. You can see that big dip in 2022 and then the dramatic recovery. And it really highlights how the different pieces work together. That Ventures engine provides the stable base, but it was the massive rebound in the investment engine that really drove the overall comeback. This is exactly how the model is supposed to work. The diversification across the engines helps smooth out the ride.
So, okay, with all that lumpiness year to year, what's the actual bottom line? Well, from Markel's management, the number one metric they judge themselves by is growth in book value per share. You can basically think of that as the company's net worth on a per-share basis. And over the last 5 years, they've grown that number by an average of 11% per year. At the end of the day, that's their report card. That's the proof that the three-engine machine is actually doing its job.
And that brings us to maybe the most important part of the whole story: capital allocation. What management decides to do with the profits the business generates. This is where that mini Berkshire nickname really, really matters.
Think about it. Every dollar of profit that comes in, management has to decide where to put it. They've basically got 4 choices. They can reinvest it in their insurance operations. They can buy more public stocks and bonds for the investment portfolio. They can go out and buy a whole new company from Markel Ventures, or, and this is a big one, they can buy back their own stock. Whatever they choose to do tells you a lot about where they see the best value.
And here's a perfect real-world example of that discipline. A little while back, the market for buying private companies got really frothy. Prices were just sky high. So Markel's management looked at the situation and said, nope, we're not paying those prices. They basically stopped buying businesses for Markel Ventures. So the question is, what did they do with all that cash instead?
They bought back their own stock, a lot of it. In 2024, they spent a whopping $573 million on share repurchases. Now, as an investor, that is a huge signal. It's management screaming from the rooftops that, out of all the possible things they could invest in, they believed the absolute best deal on the market was their own company.
All right, so we've taken apart the three-engine machine, we've looked at the numbers, and we've seen how they decide to spend their money. Let's put it all together. What's the bottom line for someone thinking about investing in this company? What are the big risks and the potential rewards?
So the investment thesis really boils down to a few key things. On the plus side, the bulls would say their new focus on specialty insurance is going to lead to better, more consistent profits, and they'll use that cash to make a great acquisition or keep buying back stock cheap. And eventually, the market will wake up and give them a higher valuation. But the risks are definitely there. An insurance-specific risk is adverse reserve development. That's a fancy way of saying they didn't save enough money for future claims. And of course, there are external risks like a huge hurricane, a nasty bear market, or just the simple risk of management making a bad deal.
And there's one last piece of the puzzle here that I think is really telling, and it has to do with their culture. This quote points out that their accounting is generally seen as conservative. What does that mean? It means they tend to err on the side of caution. They set aside more cash for future claims than they probably need to. In the short term, that makes their earnings look a little lower. But if those big claims never materialize, that extra cash flows back as profit in the future. It's the kind of thing you see from a management team that's playing the long game, not trying to impress Wall Street every single quarter. So, all of this leaves us with the big question. You've got this proven three-engine model. You have a management team that is incredibly disciplined and acts like they own the place, and you have this conservative long-term culture. So, is Markel that rare thing, a powerful compounding machine just hiding in plain sight, maybe overlooked by a market that's obsessed with the next 3 months? For the patient investor, that's the real question, isn't it?